In other news, short-term interest rates are higher this morning, meaning many Americans face increased borrowing costs. The Fed hiked rates yesterday by a quarter point to a range of 2.25% to 2.5%. That's the fourth rise this year and the highest level since 2008. The Dow closed down almost 352 points after the announcement. It was the lowest close of the year. CBS News business analyst Jill Schlesinger is here with how that rate rise affects you. Good morning.
Good morning.
So the New York Times breaks it down great, I think, this morning, because it says it makes a difference whether you're a saver or a spender. If you're a saver who's got money in the bank, you're getting higher interest. You're doing well, right? If you're a spender who, say, let's has $10,000 on a credit card payment, how does this affect them?
Borrowers are most significantly impacted, especially with credit card rates, which, by the way, are on average about 17%, maybe more. So for an average credit card borrower, that might mean a few extra dollars every month. But if you've got a huge balance outstanding, it could be a big difference. Other things impacted. New auto loans. So you go out and get a new car, might see a higher price, maybe over 5%. You might see private student loans start to rise. Adjustable rate mortgages, some of them adjust on an annual basis. You might see a higher price there. And for your home equity lines of credit, those start adjusting pretty quickly, like 30 to 60 days. So people could start paying more for the money they've borrowed.
And Jill, it seems important that because the Fed has said they're going to keep rising rates, they think the economy is strong, they're worried about inflation. The warnings you're giving about rate increases, there might be more. So you've got a long-term plan. It's not just reacting to this one.
Oh, absolutely. So if you are looking at an average credit card balance, you know you have to pay it down. Here's your incentive. The Fed itself said 2 more quarter points next year. It's not written in stone, but you know you have to do that. Put that on your New Year's financial resolutions. We'll do that next year. But I want you to be very clear that it is going to impact you. But again, as you said, Bianna, for savers, it's fantastic. If you are a saver, all of these rate increases, 9 over the last 3 years, have finally gotten those interest rates up on checking, savings. I looked at CD rates, 2-year CD rates, now finally poking over 3%. Great news, especially if you're a retiree.
But isn't it kind of a yin and yang because the stock market's going to go down?
Well, this is actually a very interesting thing, because vast majority of investors, economists, analysts did expect that quarter point increase yesterday. So why did the market sell off? Right. The big reason is that during his press conference, Chairman Powell really didn't make people feel better. He said, yep, we're going to probably do 2 next year, and we're on it. And it almost seemed like automatic. And investors were very concerned because they felt like if you're on some automatic program, that's not good for stocks.
It's also rare that you have the president stepping in and giving his views on the Fed's decisions as well. Maybe that's confusing investors.
Yeah, I mean, look, I think that the president doing that, it's not really impacting Powell. And in some respects, it may be putting his back up against the wall. Fed officials are really not usually guided by politics. Although, look, they got to report to Congress twice a year, so it is important.
All right, Jill, thank you.
Jill.
Always good to have you here.
Thank you.